One of my next guests says not necessarily. Joining me now here on set at CNBC headquarters is Chad Morganlander. He's Senior Portfolio Manager with Washington Crossing Advisors. Welcome to you. And Gina Sanchez is here. She's Chief Market Strategist at Lido Advisors and a CNBC contributor. Welcome to both of you. Gina, first, pound the table on dividends for me, because I'm certainly hearing a lot of talk about this right now and why it's the right strategy for a market like this.
So look, the challenge to dividends is just that they're going up against higher interest rates. But if you pick the right stocks, you also have upside to the stock as well. So it's not just a pure dividend play. We think quality is important, and there are parts of the dividend universe that are really expensive, defensive but expensive, we like to call them. But we're looking at the cross-section of really great companies who make tremendous revenues, profitable, and whose dividends are growing, and that's in the healthcare sector. So we think that there's definitely places where you can identify still cheap stocks, great outlooks, and everything that goes with that.
J&J, Abbott, Bristol-Myers, obviously J&J a little more controversial, but Abbott, Bristol-Myers, 3.5% or so we're talking. Chad, I don't know if that sets off any alarm bells for you, but you're saying, obviously, when you pile into dividends, don't just look for the highest yield out there on the street. I mean, what are the thresholds of the things to look for to know that your dividend payer is going to be safe?
So not all dividend payers are the same. High dividend payers more likely are similar to junk bonds. Many of the high dividend paying stocks have a large amount of debt on their balance sheet. They have poor returns on their investment when they reinvest back into their business, and they may very well have erratic earnings and revenue growth. Hence the reason why you want to stay away from those low-quality, high-dividend payers.
Do you think they use the dividend as a way to lure, to basically say this is all we have to offer?
Well, pretty much, because you have low returns on invested capital, meaning you reinvest back into your business and you don't even earn the dollar that you reinvested back into your business. Hence the reason why we've done a lot of research. You want to be in rising dividend companies that are quality. Quality is different for everyone. Our definition of quality is quite unique.
If I had to put you on the spot and say, what dividend payout do you start to get nervous? Is it 5%, 6%, 7%, 8%, 9%, 10%? I mean, would anything below, and I know that's not how you would process it, but just in kind of generally speaking.
So probably around 25 or 35% is a healthy dividend payout.
In terms of income, but I meant in terms of the dividend yield.
From dividend yield, you should focus on dividend yields below 2.5%.
Really?
So you're looking for companies that or have high revenue growth, they have high returns on their invested capital, and very little or no debt on their balance sheet. You stay there, you can get a fair return with much less volatility.
Okay, Gina, I'll give you a quick last word here, because these companies would be a little above that threshold, but do you feel comfortable with them?
Actually, we agree that high quality is absolutely important. It's core to our strategy, and we are looking for that. And there are definitely places like utilities and, like staples where that is the case, where you're getting below that 2.5%. The reason that we're highlighting healthcare, it's one of the few places where you can get high quality, strong balance sheets, strong financials, and a yield that is actually competitive to the 10-year.
I learned, and we did it all in about 2 minutes, but thank you both so much today. I really appreciate it. Gina Sanchez and Chad Morganlander. Such an important topic here. Everyone's talking about dividends.